Bandhan Mutual Fund presents MF Corner.
Hello and welcome to the special edition of Mutual Fund Corner on YouTube. I'm Vinnii Motiwala, and today we are discussing a very interesting topic, right? Everyone has seen that pick up in the pace of sector-specific mutual funds. Everyone wants to invest in sector-specific mutual funds. But what is the risk there? What are the things that you should be keeping an eye out on? And, whether the risk associated to these specific mutual funds, sector-specific mutual fund, compared to diverse funds, what should one be watching out for there? And to discuss that, we have Kirtan Shah, founder and CEO at Credence Wealth Advisors, joining in with us. Kirtan, thank you so much for joining in with us. And let's talk about this, because this is a trend that has picked up pace. Now, obviously, what is that one investor should analyze in the current market trends while they are considering this sector-specific mutual fund? What is the key over here? Because there is obviously some bit of a risk here, right?
Oh, 100%. I think while you are investing in sector funds, you have to understand that you are taking a very high concentrated bet on a particular sector. And if that bet really plays out, you make far higher returns than a diversified investment that you would otherwise do. But if the bet goes wrong, the concentration on that particular sector will end up hurting you as bad, right? Because what can happen is typically, let's say, one result in that particular sector goes wrong, the entire sector and all the stocks in that ends up taking a beating. You probably might have a government policy that comes out for that particular sector that hurts the sector. Something happens globally that might end up impacting that sector. So when you take sectorial bets, the biggest problem is the concentrated risk that you are taking. And even if a small thing has to go wrong in a particular sector, because there is no diversification outside of that sector, the sector will significantly underperform, right? I mean, I remember infrastructure in 2008, it actually took 10 years for investors to get back their principal to the levels that they invested in 2008. So if you get your sector calls really well, you get significant alpha. But if you get your sector calls wrong, I think the biggest problem is a very high chance that you will keep underperforming on your investment for a long time versus a diversified fund. And also, in my opinion, sector funds are typically for more sophisticated investors, because if you look at a more diversified fund, you will have diversified funds where they've invested in multiple sectors. So if one of the sectors don't do well, the other sectors will do well, and hence there is a balance in the portfolio. But when you invest in a sectorial fund, you have to be very cognizant of the fact as to why are you investing. And also from an overall portfolio standpoint, like say, for example, if you've invested in 4 or 5 diversified funds, which already have a lot of banking and financial services that they've invested in, it doesn't make sense for you to invest in a BFSI sector fund, because it'll add too much of concentration to your already overall portfolio.
Right. Kirtan, there was one point obviously you were mentioning is in terms of sector rotation also, and how maybe earnings are bad. So that is something that could impact the sector as a whole. So how can, if you could explain our viewers firstly sector rotation and the performance, how important that is in terms of sector-specific funds. You did highlight a bit on that.
I think, look, what typically ends up happening in sector rotation in very simple language is that all of these sectors are very cyclical in nature, right? So you will have 2-3 years of performance on sectors doing extremely well, and then you probably might have a 2-3 year dull in performance. Let's look at IT, right? In 2020-21, IT funds did extremely well. But then you had a 18-20 month of period where the IT funds did not do well at all. And then suddenly over the last 3-4-6 months, IT is back in flavor. So typically what happens is all of these sectors are extremely cyclical because of multiple reasons that we spoke about earlier. Now, if you get the sector call right and the cyclicality right, you are in for making a big money. Right? Because had you got your IT and pharma call correct in 2020, then in 2020, 21, 22, you would have made very large returns. But let's say if you looked at these returns and entered in 2022, you would have been for a serious underperformance in 22 and 23. Right? Now, if you look at it currently, let's say banking, private bank or PSU banks currently, or chemicals, right now, this sector has not done well at all over the last 6-8 months versus the broader market. Now, the general consensus is because these sectors have not done well, there is not a lot of interest in this sector. But like I said earlier, also, in my opinion, value investing is the right way to do sectorial investing. If both of these sectors have not really done well over the last 2 quarters, 3 quarters, or 4 quarters, probably this is the time to get into these sectors, because here is where you can expect that when the earnings revive, this quarter will come back in terms of performance, and that's how you create alpha over the next 12-18 months.
Sure. Kirtan, I want to understand how important it is that, maybe is it possible to diversify within a sector mutual fund as well, right? Pick up one sector specific mutual fund, pick up another sector specific mutual fund. Does that reduce the risk maybe that an investor is looking at when they're investing, to diversify at least while investing in different sector funds?
I think, Vinnii, that's a little complicated in my opinion, is because, look, first problem is that mutual funds do not have sector exposure or sector funds available for all kind of sectors, right? So let's say, for example, I feel chemicals today are undervalued and I want to invest in chemical as a sector. But is there a chemical sector fund available in mutual funds that I can use? The answer is no, right? Let's say I'm looking at private banks, say for example, where I see a lot of value today. But when I look at a diversified fund that I've already invested in, 30-35% of my investment is already in banking and financial services. So what you have to understand when you take sectorial bets, first, in my opinion, is that the diversified funds that you hold are investing in which sectors and specifically not investing in which sectors. Like say, for example, typically these diversified funds have 6 to 8% weight in IT, or 4 to 7% weight in pharma, but they will have 30-35% in banking and financial services. So if I want to take sectorial bets, I might as well not take banking and financial services, because it already has a 30% weight in diversified fund, right? So I might look at IT or probably pharma, if at all I want to, so that there is not a lot of overlap.
Okay, sure. And when is it appropriate actually for an investor to exit a sector specific fund? Are there some key triggers or signs that one should be watching out for?
I think the easiest way to do is when there is a lot of euphoria and everybody is looking at investing in that particular sector is probably, in my opinion, the best way as a retail investor for you to look at to get out of the sector. To give you an example, I think post the performance of manufacturing or defense, we saw a lot of mutual funds come up with sectorial or thematic funds of that particular space. And we've seen what has happened over the last 6-8 months, that these funds came out with those sectorial funds. We've seen them perform significantly underperform, right? So one trigger is, of course, when there is too much of euphoria and everybody is talking only about that particular sector, maybe one very interesting way to look at when to exit. One other data point from a retail standpoint, which is not very technical in nature, whenever you see mutual funds come out with NFOs on a particular sector, that probably may be a trigger that there is too much of interest in this particular sector and you might want to look at booking some profits.
Okay. And Kirtan, lastly, what is it that you would advise a sector fund or a diversified fund? What is the best option for a person who's just started investing or an investor, retail investor?
I think my answer is very clear. You should really look at investing in a more diversified fund, because you probably are not aware of which sector will play out when, and don't want to end up taking too much of concentration risk, because your ability to judge which sector will do well and also at the same time decide on the entry and the exit point is too much to expect from a new or a retail investor. A more diversified fund is actually the way to go about it. In fact, if you have 8 years, 10 years of investment horizon, the best way to do is split your money across large, mid, small, all three, and allow the fund manager to do the remaining bit of the job in terms of selecting the stocks that they want to invest in. I think that portfolio will end up doing much better than trying to time the market using sectorial funds.
Okay, Kirtan, thank you so much for joining in with us on the special edition of Mutual Fund Corner on YouTube.
Thank you so much for having me.
Bandhan Mutual Fund presents MF Corner.